Welcome to a new episode on fundamental analysis of stocks, and this episode is about auto OEM and especially the passenger car segment. In this episode, we will talk about the size of the market, how big is our target market. We will talk about the barriers to entry, what are the problems when a newcomer enters the market, can they disrupt and take on the existing players. We will talk about the R&D capabilities that is required for a company to be able to successfully deliver products year after year. We will talk about the service quality that's required to be able to dominate the market. And we will also talk about the product development cost. That's kind of something that influences auto companies a lot. They need to be constantly on their toes, making sure they are always on top with new models coming out and refreshes being sent out in frequent intervals. So the size of the market. How big is our market? It's very clear that India is not a saturated market for passenger cars. Having said that, we need to understand that the population cannot be used and compared against, say, something like in the United States, where we can call with numbers such as how many cars per household and how many families do own a car. But think about it. Can we do such an analysis on car segment in India? Because we have a very large population who don't have basic amenities, and cars are not one of them. So let's think about it. Let's talk about the middle class population alone. How much amount of growth do we expect for this specific segment? The middle class. The middle class who just graduated, and it also includes the middle class who wants to go up one more level. We can call them upper middle class. So that cream on top and the bottom layer that gets added up and the middle chunk that's already there. So we will discuss about that particular market alone. And if we talk about this market, it's very clear that if you look at the 2016 value that we have, the estimate, and the estimate for 2025, you can see that we are going to double the middle class population during this 10-year period. So when we talk about the auto segment, we need to think about the replacement demand as well, because people replace cars from time to time, and the interval seems to be reducing. When people get more affluent, they want better cars, want to stay with the trend, and always want the best of amenities. The good news here is if people don't upgrade their car, if they don't replace their car, they need to run their old cars. And when you run an old car, you would definitely have to run in with some amount of spare parts being replaced from time to time, and the margins for these spare parts are significantly higher when you compare to even a new car that's being sold out. So the margins on spare parts will definitely be a very good chunk of income when you see more vehicles being put into the market. And if you have a good market share, and if you can make sure you put a whole lot of cars in the market and they need replacement parts, your margins will be significantly higher. So now let's look at how the segment as a whole behaves in the Indian automobile industry. Let's talk about how much growth have we seen in the passenger car segment. And to do this, let's look at a very conservative figure. How do we do that? Let's look at, say, the 2011 values. Let's look at the highest amount of cars sold in any month in 2011. That's 2.3 lakhs. And now let's look at how many cars were sold in 2018, and let's look at the lowest figure. To be conservative, I'll look at the lowest figure in any month, and that's 2.68 lakhs. So this growth will be a very conservative growth that we can look at to value how much of a potential we have over the next few years and maybe a decade from now. That's a CAGR of less than 2%. So it's a very slow grower. The segment is growing very slow. Now the interesting catch here is, are we going to grow as slow as this for the rest of eternity? Possibly not. If you think about a very fast grower, do you think they're going to grow as fast as they grew for eternity? No. At some point of time, they will slow down. Similarly, a slow grower in a market like India, where the middle class aspirations run high and the middle class population is growing, this slow grower is going to become a fast grower. How much fast is your story, and you need to figure that out. But we know that things will change, and the change will be good. Slow growers tend to become fast growers in the long term, and fast growers will come down and average down so that they become slow growers in the very long run. That's the essence of life. And since this is a slow growing segment, it's very clear that with the aspirations that we see with the Indian middle class, things are going to get better. So now we have decided that this particular segment, the auto OEM, is interesting. So we will now dig deeper and to see what are the barriers to entry. If we pick a stock here, how risky is it to see a new entrant come in and take away everything that we have built so far? So one very big barrier is the size of the network, both the sales network and the service network. How big is your sales network? Can you really be able to get into the rural population? If you look at the mix between the urban and rural, in the past it was usually the urban folks who were buying passenger cars. And not only the premium ones, but even the commuter segment, the lower segment, the hatchback segment, the A segment, were all dominated by the middle class urban population. But now it's being switched over to the rural population. We have seen this from 2014 that the rural growth has been substantially higher. The urban growth is there, but the rural growth has really picked up. And this is going to be a very big change for a passenger car segment, because the slow growth, the lower base, and the huge aspirations for a very big country like India. So can you get your service network to every nook and corner? Think about it. That will really put a barrier to a new entrant, because getting so many dealerships with specific quality and the service network being spread across the country is not going to be easy. And getting a brand awareness is very important. Do you want to be pictured as a very good performance-oriented product? Do you want to picture yourself as a company that provides the best service quality? Or do you want to say that you are a company which can produce cars with utmost quality that you would never see a breakdown? What do you want to visualize? And how do you want to visualize your brand? So that is a very big entry barrier, because if you get into a segment and compete with a player who has a capability to provide highest quality at lowest price, is it possible for you to compete with them? Think about it. So thinking about competition, you should look at how big is your production volume. Can you do mass production and bring down the cost? And if you can bring down the cost, and can you provide the best quality product? If you can do both, that puts a very heavy barrier, very wide moat around you. If you can get efficiency of scale, it really makes it very difficult for an entrant to get in and crack into the market. That's exactly what we have seen in the passenger car segment for the past several years, and it has become very evident in the recent past. So let's talk about the R&D capabilities. Think about it. We want new cars, new models, and these cars need to have the best of capabilities in terms of performance as well as features. So an automobile company has to refresh its model lineup and has also to provide new models from time to time. The refresh cycle is maybe 2 years, and the new lineup, new products need to come out every 4 years. That has become a norm these days. So the cost of R&D is pretty huge, and we want the payback period to be as minimal as possible. We want to get back everything that we put in for the product development. It's very rare to see the cash flows coming in for a product that's very old. If you see such a product, then it is an extremity. It's an outlier. If that happens, then you're milking the customers for a long period, even after the life of the platform. For example, Maruti sells the WagonR, which is an age-old platform. The product development cost must have been recovered years and years back, and whatever revenue that's coming in are purely free cash flow. The product development has been completed years back. The refreshes are so minor that the incremental cost to do that could be recovered by selling very few number of cars. So those are outliers. They don't happen too often. So in general, the product refresh cycles and the new product development has to happen very frequently. So that is a very big cost for an auto company. So to mitigate this, what do we have to do? The auto company needs to be able to recover the cost quickly, the payback period being low, the NPV being very high, and that is possible if you sell huge amount of cars at the right margin. The margin is right, and if you can sell huge volumes, then you are going to be a very big winner. And if you look at the companies that are selling cars in India today, check out how much is the margin. If you look at Toyota Innova Crista, then you will see that their margins are very high and the volumes are significant as well. So the product development cost could be absorbed pretty quickly, not to mention that it's an international product where multiple markets can actually contribute to the recovery of the product development. Similarly, if you look at products from Maruti, a lot of them have been either been produced long time back, such as WagonR, where the product development cost was recovered and the free cash flows keep flowing in. And you also see new models with very high volumes with a decent amount of margins, not so high, but not so low as well. And still, due to the volumes, they are able to make a good amount of free cash flow. And we will see that in the upcoming slides. Now let's look at the service quality. Think about it. Why do we need to provide the highest of service quality? To retain our customers. If a customer buys an A segment car, we want him to buy a C segment car tomorrow within the family. You don't want him to shop around. We don't want him to go outside the brand. So we want to make sure we keep our customers happy and make them stay within the brand. So to get repeat customers, service quality is required. To get new customers by way of free marketing, word of mouth marketing, we would need to make sure our service quality is really good. Thereby, we would get free referral, products are sold, customers are happy, they tell their neighbors. And in India, the herd mentality is something that you can see when someone buys something, and if it's good, if he tells someone else, that someone else buys it as well, and again the cycle continues. So what is the secret sauce to make the customer happy? You know what? It's capitalism, right? So the money can make a difference. If you can keep the dealers happy by providing perks, the right perks, and giving them the right amount of profit that they need, by giving them good amount of margins, by making sure that the dealer can earn by keeping the customers happy, you are able to enforce excellent customer support. And that's exactly what we have seen with certain companies like Maruti, for example. They were able to do that consistently for a long periods of time, and that is something that we need to look at. How much important is customer service and who is able to do that? How do they deliver that? Take an example. If you want to buy a product, a replacement part, usually it's available from third party as well. But now Maruti wants the third parties to buy it from a dealer, thereby making sure that the profit margin is shared with the dealer, making the dealer very happy. End of the day, we want the dealers to be happy, and dealers are happy, the customers will be happy. So that's a very easy way of putting it together. But to do that, you need volumes, because that makes your cost structure go down, your efficiency go up, and that means you can give some part of the profit margin to your dealer, and the dealer can be happy with whatever he gets, provided the volumes are high. So now let's look at what happens when a company is able to grow faster, pretty much faster than the industry average, and what does it do to the underlying business, and how the investor can reap benefits. In a slow growing environment, if a company is able to grow at a very high pace with good amount of margins, it deserves a decent valuation. So if you spot such a company, please do enough research, because you don't get these opportunities often. And if you get an opportunity like this, make the best use of it. So if you look at this stat, you can clearly see that Maruti was able to sell 26% more than the industry average. They were able to do it pretty well, and their margins are going up. What does it tell you? You are actually grabbing market share from others. And when you do that, and if you can even keep on raising your margins, not reducing them to capture the market, because that's what people do, right? Businesses always want to sell more. Sometimes they are able to do that by reducing their price, thereby reducing margins. But here, if you look at this example, the margins are not going down, but the volume is going up. So they're doing something right. And what are they doing? And that's something we need to look at. It's worth understanding what's going behind the business to understand how the value would turn up in the next 10 years. So people always complain that auto companies need frequent capital infusion to make new products, new platforms, to be able to get refreshes for old aging products. So that's the story for a car company. So that's the reason why car companies are valued less, because they need to be pushing cash into the business to develop something for the future. So the asset is not going to be forever. It's going to be for a limited time span. The depreciation is high, and you in fact have an accelerated depreciation for some of the products. But what if you have a company which can actually be asset light, can produce huge amount of profit, a substantial amount of profit from a very low base of capital infusion every year? Think about it. Say for example, Maruti is producing enough sales to get a profit of around 9,000 crores, and all they need is 2,000 to 3,000 crores to get to that 9,000 crores every year. If you can do a CAPEX of 2,000 to 3,000 crores, keep growing, they can make over 9,000 crores every year. So they don't need to go for a debt. So these companies are really interesting to look at. And let me make a disclosure here. I own Maruti. So please keep that in mind. I own this company. So I'm giving an example because I understand that pretty well. This is not a buy or sell recommendation. Not asking you to buy or sell. This is my personal opinion. It's only for educational purposes. Please keep that in mind. So when it comes to auto sector, especially in India, it's the chicken or the egg problem. You need high volumes to be able to produce quality products at a very optimized pricing. The efficiency of scale is what you need to be able to push great quality products, very good quality products. But if you need to produce high volumes, you need to produce good products. So if you cannot get the volumes, you cannot produce great products at good prices. So the chicken or the egg problem is a very big issue and an entry barrier for the auto sector in India. If you have the top company inching towards 50 and more, 50% market share and still climbing. And if you have another company, the second one being at 15%, what is going to be the fate for the other players? They're going to be in single digit, and the bottom will always keep dropping off because they can't sustain at less than 1% market share. And we saw General Motors quit India because they were at the bottom part. That's a good example where the market share needs to be substantial for them to justify staying in a market. So this brings us to the end of this episode. So we can conclude that there are some interesting companies in this sector, and since it's a slow growing sector, we need to be very cautious, and since the CAPEX will actually influence how much amount of investor wealth it can create, we need to be very careful in picking the right company. We need to decide and dig deeper. So in upcoming episodes, we will talk about individual companies and see how their growth could be in the next few years. Until then, bye-bye, take care, and don't forget to subscribe to my channel and press the bell icon to make sure you receive my videos every time I post a new episode.